Thanks for joining us again for another webinar on what they didn't teach you at school. This series is all about covering off on some of those financial planning or financial related matters that people need to think about within their lives, but they don't often make time to prioritize it, or maybe they don't know where to start, hence the title, What They Didn't Teach You at School. In our previous ones, we talked about cash flow, a lot of discussion around cash flow budgeting for your personal finances. And in our last one, we talked about superannuation. What are the requirements? How can you put money into super? What are some of those other broader considerations? But today we're going to talk about insurance. And we're not talking about the general insurances like your house and contents insurance, those types of things. We're talking about the personal insurances like your life, your permanent disability, or your income protection insurance. And so to help me with that today, we of course have with us, we have Mitch from Brisbane's Financial Planning Division. Thank you for joining us again, Mitch.
John.
And of course, we have Simone Murad from a business depot down in Sydney, who's across both the accounting, but heads up the financial planning team down there as well. Good to have you on again, Simone.
Thanks for having me.
Now, today, of course, anything we talk about from a financial planning basis, we always have to remind everybody about the advice we talk about today is, of course, general in nature. We remind people that you should also always seek advice specific to your situation. And of course, what we talk about is really just intended as some general comments for you to take away so that you can apply it to your own situation. We are happy to take any questions today. If you could please use the Q&A button down the bottom, much easier for us to manage than the chat button. Feel free to pop them on there and I'll be monitoring those and I'll be happy to ask those as we go throughout the webinar today. But guys, let's get straight into it. And I'll ask you both this question, but I might ask you first, Mitch, if you don't mind, just at a very general sort of level, why and when should you be having insurances against your life or to protect your income?
Look, at a very foundationary level, we want to make sure that if your family or business is in a situation where you need to promise funds at some future point, you're considering offloading that to an insurer to provide a payment based on a health event occurring, whether it's death, disability, or anything in between.
And what about you, Simone? How would you answer that question? You know, when should we be thinking about insurances over our life or to protect our income?
Yeah, look, and I think we've got a bit of a slide on life stages that would be good to share, because when we're thinking about insurance, there are 5 stages that we typically go through throughout our lives. So being from when we're younger and we're starting out with our career, we're looking at wealth creation, but we might not have the sort of long-term financial commitments that we would potentially see later in life. And then, looking at the next few stages, we've got building wealth. Maybe you've got a young family, taking on that first mortgage, and then moving through our different life stages to, really consolidating the financials. Maybe you're sort of career focused in that sort of mid stage of life. You're looking to reduce your mortgage, and retirement planning might be coming on the agenda. Further to that, though, is looking at, when your risks start to reduce, you're looking at sort of, okay, what's the plan now? So it's building wealth for retirement, thinking about retirement, and then in retirement as well. And the key thing is that over these different stages of life, you have different needs for your insurance. So when you've got a young family and you're building wealth and you've got maybe the maximum amount of debt that you might take on, it's a really critical stage to think about having insurance to cover all of those risks, because you've got debts and you've got dependents. But as you get into sort of that pre-retiring stage, or more so retiring really, your financial risks are lower.
You sort of got your stuff sorted by then, you hope, don't you?
That's right. So, and it's important to have a look at those risks over those different lifespans and adjust accordingly.
And something I find really interesting about that is obviously there's different risks at different points in time, depending on your situation as well. Because there's risk of your own life and what's the impact of you not being able to work and being able to feed the children. but there's also a business overlay on that. And so that's something I want to make sure we cover off on today, that, it's not just about protecting the family. It might also be about protecting the business and the people behind the business as well. But I also can't help but notice on that diagram that the need for insurance is at the highest when they've probably got the least money. And that probably will lead to one of our other questions a little bit more later on as to, the affordability question. So let's dive into what are the different types of insurance that we have. And again, I'll start with you, Simone, if you don't mind, and just at a high level, what are the different types of insurance that fit into these categories?
Sure. I mean, at a high level, look, you've got life insurance, and that covers you essentially for death, but also it covers terminal illness as well. Life cover is paid out as a lump sum, so you generally take it out as a lump sum, potentially to cover debts, and also potentially maybe to provide a lump sum that your dependents could invest for an ongoing income. TPD, as we often refer to it, is total and permanent disablement, and that's another lump sum cover, and that covers you for the lump sum that you choose, depending on how you calculate it. And then you're looking to be able to claim on that, you need to be totally disabled. So generally with TPD, you're looking at 2 medical professionals signing off to say that you're totally disabled, you can never work again. With trauma insurance, trauma is another lump sum cover. Trauma typically covers a range of specified trauma events, such as heart attack, cancer, stroke, MS, and there's plenty of others as well. And then income protection is it's not the lump sum, it's replacing your income. So with the income protection, you've got a monthly payment that's coming to you over the life of the policy.
Obviously, I get the impression all 4 of them sort of intertwine somewhat, in that you can't just look at one in isolation, and that if you only have death, obviously that's not going to cover you if you've got cancer and you can't work. And so I then see that trauma and income protection sort of linking together there.
Yep.
Mitch, what are some of the other common features? Or I know there's a few sort of specialist sort of types of insurance products that fit into these categories.
Sure.
Well, tell us about some of those specialist products or special features.
Yeah, for sure. I guess in addition to what you're looking at on the screen, which I call the traditional type of insurance, your lump sum life, TPD or trauma, and your income protection, there's some other developments that have come out in the last, say, 20 years. Might be a business owner needs to actually have some additional cover to protect some of the on-costs that a sole trader might expect in the event of him not being able to work. Hypothetically, an electrician works for himself and he needs to claim on his income protection. He might have lease expenses on equipment and so forth. And so with business expense cover, typically that cover's there to try and help cover some of those expenses in that smaller business and enable him to actually use his income protection for himself and not actually have it taken away just to cover off his business expenses. So that's one example. Another good example would be a severity-based contract that's come to market in recent years. I think that might be the way of the future, to retain the insurances to be somewhat affordable both now and into the future that are offered by insurance providers. The premise of that particular cover is to say that in the event of your ill health, there's a range of conditions that are covered under that particular contract. It's going to provide you a payout scales based on the severity of your health event. So if it's a very minor event, it may pay you a very minor payment, perhaps 5%, right up to 100%. If you had a very major event in your life occur, it would then be scaled and actually pay out the full amount of the policy, as an example.
We had a graph up there before about the need for the different insurances at the different stages. And I imagine there's a whole other range of lines we could have on there for those different types of insurances that you talked about there, like the child trauma and the severity and those types of things. Is there a relationship between cost and severity as well? And I suppose what I mean by that is, when you die, you get a payout and they know what they're going to pay you, but you're done. Whereas some of these trauma sort of style events like cancer and so forth, you've not only got ongoing costs of your own health and everything, you've also got the same impact on your family. Is there a relationship, Mitch?
Yeah, the relationship's very intertwined. To say, trauma cover was brought out in the early 90s, late 80s by a cardiologist that saw a need around heart surgery and saying, well, the cost of heart surgery is astronomical back then. it's since developed to be this beast that's covering many, many conditions. So insurers are in a position of offering cover based on statistics. So the chances of someone suffering a medical event really is how they're basing their premium, not only on age and occupation, but on the other factors as well. So the challenge with insurance is to try and find that happy medium between having the right amount of cover for today, but also making it affordable into the future. So you're not actually taking it, you're not overcommitting yourself from a cash flow point of view.
Yeah, I mean, I know income protection. I know how much my own income protection sort of costs, and I know I do look at it and I go, oh, I'm not so sure about that. But I guess that's because it's an ongoing sort of payment as well, isn't it?
That's right. So it's really weighing up your previous health. And the good thing in Australia, at least at this current point, we have contracts that are guaranteed renewable, and that's another piece we'll talk about shortly. That effectively, regardless of what one's health might be in the future, so long as it's underwritten appropriately at the time and all full disclosures are made, then you can guarantee, so long as you keep paying your premium, the insurer is on the hook to actually provide you the promise that they've been providing a bit of paper, turn into real money in your bank account.
Have you got some, I suppose, have you got a story? And I'm probably thinking about income protection here, Mitch, more than anything else. Have you got a story around how those claims sort of work? Because I think often people look at the premiums, but they don't necessarily look at the success stories of when it actually has worked well.
First and foremost, the thing to say would be most often I hear about a lot of claims by accident in a review where they've come up and said, I've injured myself 6 months ago, and they forget, they even mention they've had income protection in place if they're a new client, or indeed if it's an existing client even we're talking to, perhaps will tell me more about that event. So a couple of recent claims would be certainly around broken bones. It's a very common one where some contracts may include specified injury payments where there is no requirement to have a waiting period in many examples. And we might actually be able to afford, or the insurance company afford, paying out a monthly or a couple of months worth of benefit depending on the actual fracture. Would be my most common claim. Further afoot, the most important claim is certainly when someone's really financially distressed and they're talking to perhaps cancers or heart attacks, and really they need to not worry about the money, they just need to worry about fixing their health. So seeing those people be less financially stressed and be in a position to actually know that the insurance company's got their back. Obviously, there's conditions around waiting periods that need to be considered depending on the contract. There's other provisions we can talk to in a minute about how that might look.
When you mentioned their stress, Mitch, and the last year or so, undoubtedly, there's been more instances of stress and mental health situations. Would trauma cover you for, say, mental health, or was that more an income protection sort of perspective?
Great question. So I guess the premise on most trauma contracts is no, it doesn't typically cover mental health, but the likes of income protection, the likes of total and permanent disability certainly do cover mental health when it's not been excluded at the underwriting stage of a contract. So on the premise that someone entered the contract with no pre-existing condition, contracts that we would typically underwrite with insurers is then set in stone, and then should the event ever occur, that there is a challenge with someone's mental health, then they can rest on the fact that they've got the contract that will pay them according to the terms and conditions of their contract. Let's just play that forward for one step. If it meant that that person was only off work for 6 or 12 months with a very reactive depression or anxiety or stress on an event in their family or in their business, then certainly they can rely on the insurance company to pay them some monthly benefit and help them get back to work. Of course, if it's a more significant challenge to their health, then of course they'll carry them right through the end of the waiting period, which typically speaking, but not always, might be through to age 65, or in some cases, we'll talk about again, within some super funds, there might be some preset conditions around only having a 2-year benefit period perhaps.
Yeah, okay. Simone, tell me about, and I know you've got a slide on this, so I'll throw this up for you, but tell me about some of the stats around claims and those types of things.
Yeah, absolutely. And look, just want to preface this by saying that these claims are for one insurer. So what we looked at is we wanted to give a bit of an example of different claims and an understanding of how those claims are being paid out. But certainly this is actually only one insurer for a year, being the 2020 financial year. So when we're looking at income protection, I think that when you're looking at it, the average age of the claims, we're looking at 45, with the youngest person who's claimed at 21. And I think that this is really important, because when we think about these covers, you're looking at, okay, it's quite a young age to have an income protection claim. And when you're talking about cover, and John, as you mentioned, with your own cover, the cost sort of gets up there, but when you're looking at it, it's like, okay, well, the oldest claimant was 67, so there are claims all through that life of the policy there. And I think, as you can see, mental health is right up there with 29% of the claims in that area. And I think that's particularly really important at the moment, because if you're entering into a policy, then you really sort of want to get in there and get it before you've experienced these issues, because once you have, they're generally excluded. The other sort of the claims that are there, like when you're looking at trauma claims, and trauma is typically one of the more expensive insurances, because generally speaking, it's highly claimed upon, 50 being the average age of the claim, and the average payment per claim being 200,000. So if you experienced a cancer and you needed some time off of work, but you weren't necessarily stop working forever, trauma is going to give you that respite that you need, that lump sum payment to be able to go through your treatment, pay for some of those treatment costs, and then potentially be able to go back to work. Yeah, so I can see that you've moved on to the treatment costs there, and we don't have cancer up here, but it's something that we could. One of the other big claim items, particularly for trauma insurance, is heart attack and stroke. So when we're looking at different, and in particularly trauma events, 90% of Australians have at least one risk factor for heart attacks, and the average heart attack costs 25,000 in total cost. Now, I think it's really important to point out here that this is the cost of. This is just medical costs. This actually doesn't talk about, like, these statistics don't talk about the cost of you being off work, the cost of you needing to, either lose your income for a period where you recover, or any kind of other expenses that may come up. It's only the cost of actually the heart attack from a medical point of view, and similarly with stroke, when you're looking at stroke, in Australia, we've got an estimated 96 strokes per day, and the cost being 32,000 for up to a lifetime. Now, again, this is just the cost of the actual medical cost. It doesn't, it's not the cost of what it costs you personally, financially. So I think it's really good to understand that it's not just about, okay, let's cover how much it's going to cost me, but there definitely is a medical cost to cover. It's considering, okay, what are those other types of impacts to you if you have.
Again, I suppose is why you've absolutely got to think about your own situation. If you got 3 kids at school and you got private school fees and you still want them to go to school, you got to cover for that, don't you?
That's right.
Yeah.
Sorry, John, coming back to your previous slide earlier where you spoke about the life cycle of what people need, as they're younger, they might think they're more less prone to having those conditions. And of course, I'm sure we all know friends or family that have suffered in some way. Everyone gets touched in some way, whether it's themselves or others around them. But really the thing with the insurance is to say, well, you don't have to liquidate assets. You don't have to borrow money. You don't have to sell your house. You can still be self-sufficient, create yourself a little financial barrier to create a wall of protection financially to really sort yourself out with medical care and then get back to it when the time's right is the goal.
Yeah, well, you don't want to be in a situation where you have to be dramatic and sell assets and different things like that, do you? And I suppose a big part of this is also, what's the impact on your business? Mitch, what would you say are the main reasons why you need to have some insurance in the business as well?
Sure. Look, so we spoke about life cover, we spoke about TPD, and if I focus on those two for a moment, in a business environment, if you've got business partners, there's this thing called the shareholder agreement, typically speaking, and that talks to a number of events that can occur in business as to why you might enter or exit the business. What it doesn't typically talk to or fund is if we're in a business and your equity in that business is $1 million, how do you pay that equity out or is my wife, if I had one, going to come in and actually run the business with the other business owner, perhaps a business of 2, perhaps a business of 10. And so really, I call it a business will. It really looks at, well, how do you structure the estate so that the business partners have certainty of having funding available to pay out that person's equity because of an event like death or an event like total and permanent disability? And how does the person that might suffer the condition have the knowledge that their equity in business is safe and it can be paid out to the family should that event occur? That really is the premise of why business insurance is so important.
I'd take away from your comments there, Mitch, probably 2 different types of cover there. One is sort of equity cover, i.e., if your business partners don't want to be in business with your other business partner's life partner, how do you pay them out so that they're protected, but also you get the equity so you can keep going with things? But the second part of it is also that revenue or income protection as well. For example, I know we have a policy that if I can't come to work every day, then there's a cover to cover the wage for someone else to do my job and the cover the recruitment fee of getting someone to replace me.
We often call that, in the old days, it's called keyman insurance. I now call it key person insurance. To really say, well, if we're looking at the revenue that someone generates for a business, how do we replace them so the business can have continuity of service? There's costs to recruitment, there's costs to workflow. Maybe that one person needs to have 2 people replace that same role for a period of time. It's to try and reduce the bottom line to the business suffering financially and have that role replaced. And that's key person revenue. On the flip side, there's often a key person capital. It might be trying to work out how do we try and sort out the balance sheet so that the business isn't laboured with someone's personal business debt against their name, and trying to fix that before we might even then exit them out of the business, if indeed that's part of the strategy, if their health event is such that that needs to occur.
So I'm hearing, Mitch, in determining how much cover you might need in the insurance for a business, yes, it might be that wage to replace that person's wage if they can no longer work. Maybe it's to replace the income that the business will no longer earn if they're not there. I'm also hearing that it might be enough cover to pay out your family from the business, to pay out the equity. But also you might want to think about your personal circumstances or your business circumstances. Maybe you've signed up for a big lease and you wouldn't have signed up for that lease if that person was no longer there. Or maybe you've got a heap of debt within the business that you would like to have cleared or something or other. Is there anything else you'd add to that?
Look, the main thing is, although we're talking business insurance and the application of the same types of cover, it goes without saying one still needs to have their personal insurance taken care of. The income protection is the income stream that business is no longer paying you in the event of your ill health. So most business owners are happy in partnership, perhaps for 3 months, maybe 6 months, provide you some leverage to say, hey, the business has your back. In my experience, typically after 6 months, people start to ask questions of, well, we're paying all this money out, they're not doing any contribution to the business. How is that sustainable? And that regrettably is real life, that they need to think about what's the longer term outcome for the business and that person creating an income for themselves.
But it's also protecting my family too. And that's why you mentioned before the buy-sell agreements, in that my family doesn't have to stress about taking my seat at the boardroom table, and they can be paid out and have their asset realised, I suppose. Because that's really what insurance does in a business, isn't it? It's basically a funding mechanism.
It's the funding mechanism behind the events occurring. What's our role as advisors is to illustrate that event occurring and mitigate that risk. And it could be, in some cases with some businesses, offloading half the risk and retaining half the risk and understanding what that might look like moving forward. And that could be for a variety of reasons, from funding to inequity in ages, perhaps with business partners, just trying to work through what's the right approach for the next 12 months, and then we can revisit what goes on from there.
Yeah. And of course, if you can't afford the insurance premiums within your business, then you need to have some other funding mechanisms built into your shareholders agreement or buy-sell agreement. I want to talk about the claims process, because I don't think there's much discussion out there in the marketplace about claims process. There's a lot about working out your premiums and working out the cover that you need, but I don't think there's much about stories around how the claim process actually works. Now, Simone, I might throw to you first, if you don't mind. Do you have a story, I suppose, you could share of a claim that you've been involved in that would help our audience, I suppose, understand how that works?
Sure. Look, a claim that I was involved in, one that comes to mind was actually a terminal illness claim. So the claim, essentially, the husband um, got cancer, and then it progressed very quickly. So he became terminally ill, and what happened with the claim is that because it was it's like, covered under life cover, so the amount of the lump sum was actually paid out to the wife early. Well, they were actually able to have it paid out early so that they could then use that money to make plans together before he actually passed on. So what it allowed them that flexibility to really think about, okay, what's going to happen with the family going forward, and make those decisions together, have another look at their estate planning, and get everything in order together. So it's not, she didn't have to go through it after he passed away. They did it all together. So that's one claim experience that, actually, like, whilst it's very, very sad, gave them the opportunity to make these sort of last plans together.
Yeah. Okay. So you don't have to actually pass away to be able to, if you've got a terminal illness, you can actually bring it forward. And
That's right. Yeah.
How about you, Mitch? Have you got a claim process story, I suppose, to share?
Well, the first piece of that would be to say it always helps to raise one's hand if you're a life insured. If you're not sure, to ask your advisor about, well, what's happening here. I'd rather someone do that than sit down thinking, well, that doesn't cover me. The claim story that comes to mind is a person that suffered a stroke some years ago. I was reviewing the file in a different arena at the time, and in reviewing his information, he looked fit and healthy walking in the front door, but we're going through the process, and we soon became apparent is that he'd suffered a stroke some 8 months earlier. And he was telling me about the effects that meant to him at the time, that he couldn't work. He was, a factory worker, living in semi-rural. He doesn't know his neighbours at this point, and part of his condition was that he lost his eyesight for a good 3 or 4 months and couldn't drive down to the hospital for treatment. The neighbour was happily driving him down, and they became good friends. Then telling me this story, I'm looking at him thinking, why haven't you called us? Because you have a trauma policy in place that would have given you perhaps a few $100,000 to provide you all of the care you needed and the financial support that you're looking for that you didn't have at the time. Subsequent to that, I had him bring me some documentation. We had the claim paid 8 months after it actually occurred. Now, in that case, he was very thankful. He didn't even realise his policy covered him for that. And that's the other thing, is to make sure that when someone takes a policy out, that they do understand what they're paying for, at least at a very high level. And if they want to get to the nitty-gritty down the track, they should, of course, engage their advisors to actually talk about various scenarios that they're not sure on. And that's the education piece.
It sounds like your insurance advisor should be someone that you have an ongoing relationship with, then someone who's truly going to understand what's going on in your affairs and going to know enough about you to know when something terrible has happened.
I call it driving the car. Most of us drive a car, we put a seatbelt on, we turn the engine on, we get off, put petrol in. A lot of us don't know how to change oil. We take it in for a service, every 25,000 Ks, whatever it is. So it's a bit like that. You need to just check in with your advisor every so often, just about what's going on in your life, and really overlay that with the insurance policy you've got. Otherwise, the car eventually just stops.
Yeah, which is another reason why we love having this service in-house within the Business Depot group, so that we know, or the accountants or the lawyers or whoever else is working may know first when something happens in their life, and so we can bring in the insurance advisors where necessary. Anything else you want to add, Mitch, from a claims process perspective? It sounds like the biggest tip there is just talk to an advisor.
That's certainly the biggest tip. The other thing would be claims for some people can be a scary thing. Look, we deal with it day in, day out. Obviously, for a variety of reasons, we're helping clients all the time. It's typically part of the process that most advising firms that I certainly know as colleagues, ourselves included, would offer in-house to actually facilitate that process. Ultimately, our job is to represent, the client's best interest, to get the best outcome we can in a timely manner. It always comes down to what evidence an insurer needs. If one has a heart attack, stroke or cancer, typically that's event-driven. There's certain parameters that are used to try and show what the condition might pay out. And then we look at things like total and permanent disability. It is a bit more of a challenge in some occasions to try and validate what that doctor is saying, and that can take a longer process. So I think the time frame needs to be considered depending on the claim. It is easy, but at the same time, it takes time in some occasions.
And is it harder to, like, obviously if you have a cancer or something, you've got a diagnosis, you've got a medical record, but things like things like mental health and those types of things, are they harder to prove, or how do you go about making a claim in those sort of arenas?
Sure. I mean, I guess the first thing to say would be, because everyone's got a duty of disclosure when they're actually making the application, the first thing an insurer does when they go to put a claim in, or when we put a claim in with clients, is to look at their previous, typically 5, 10 or 15 years of Medicare data and PBS, or pharmaceutical benefits. They can soon see what the doctors previously prescribed you, what doctors you've seen and when. And so they just do a sniff test. They look at, well, what was disclosed in the application? Does that align to what we're seeing on those government records? And if that doesn't, then they might go and ask for reports back then. So it's very important that people are fully upfront to try and not have the issue that they have a non-disclosure, which may indeed be an issue for them in the future. Or worse again, if it seemed to be a fraudulent outcome where someone's completely lied, then that can be very problematic for some people. The insurance company can be null and void, and I guess it's determined as to whether that's a further case for someone else to have a look at.
So obviously talking about claims, a lot of these policies have different sort of waiting periods, and obviously that affects, again, your personal situation as to how urgent it's going to be for you to need that cash. Simone, you got any, I suppose, advice, or why is it so important to consider that when you're putting these policies in place?
Yeah, sure. I can give you some information on waiting periods. So, look, I guess there's probably 3 key things that I would think about when discussing waiting periods. One of them is that with income protection, you've got different waiting periods that you can choose. So generally, you're kind of basing this around what your cash flow situation is like. So how long can you fund yourself for if something were to happen? So you might look at your financial situation and go, okay, well, maybe I have a certain amount of sick leave that I can take that I've accumulated, or I've got X amount in the bank that will cover my expenses for a certain amount of months. And that can help you to determine whether or not, say, with income protection, you take out a 30-day waiting period, or maybe a 90-day waiting period. We also see that there are some superannuation funds that will have like a salary continuance cover that might cover them for 2 years, and that sort of allows you to have that longer waiting period outside of maybe another policy there. But one other thing, so like the second thing that I would say about waiting periods is that claims are paid in arrears. So if you have a 30-day waiting period, you're actually waiting 60 days for your money. So that's something that not sort of everybody knows, and it's really important to take into consideration in your planning for your cash flow, because that sort of thing can trip you up a little bit down the track when you need the money. The third thing that I would talk to is that income protection is not the only insurance policy where there's a waiting period. So if you've got TPD and you have a claim for total and permanent disablement, sometimes the insurer will want to see that you've not worked for 3, maybe even 6 months before they'll consider paying out that claim. So that's really something to consider as well, because if something happens, you have, say, a major car accident and you can't work, you might still be waiting 3 to 6 months or longer potentially because of that claims assessment process to be able to get your hands on the money.
So what I'm hearing again is make sure you understand your situation, what your commitments are from one day to the next, so that you don't create any drama by having too long a waiting period.
Yeah, 100%.
I'll add to that, John. The one thing that comes to mind with a lot of small business owners or business owners in general is this concept of the business is my superannuation, the business is paying me, the business is my cash flow. And I agree with that wholeheartedly initially. What I then talk to a lot of business owners about is that the fact that if business is suffering because you're ill health, your dividend payments and your income can soon be wiped out very quickly, and perhaps even the business may not be no longer after a period of time. So I would suggest to a lot of business owners to really think about the longer term planning, and we might push out a waiting period to 90 days to 6 months. There's reasons why sometimes we don't go 6 months, but ultimately pushing it out, you're accepting a lot more of the responsibility yourself, but then you've got the insurance company's got your back in the event that you have a longer term claim, which does happen.
I know we touched on some of the affordability sort of questions a little bit earlier, but I might throw to you first, Mitch, if you don't mind. What would you say with regards to the affordability sort of question that obviously always comes up with insurances?
Sure. The insurance industry at large has been through a lot in the last 5 years. Royal commissions and all sorts of things have gone on. The affordability of insurance is an ongoing challenge for the insurance providers. Look, they're in business to make money, but they're in business to pay out claims. So APRA, who oversees the insurance industry, have put forward some mandates around what they want to see happen in the industry, which is changing some of their contract strengths and bringing back some core contracts. Now, that looks to be sometime later next year at this point with some of the changes they'll make. But the real emphasis on insurance affordability in more recent years has been insurance companies trying to offer better and better products and more reasons to claim. And the challenge with that is, of course, if there's more claims and there's not more money coming in, which is perhaps the case with what we've just been through in recent years, they're at a challenge. They have to put premiums up, and a lot of existing clients would have seen to their own policies these premium increases and letters saying that we're putting your premiums up 10, 15, 20, with one company as much as 70%, which is very, very hard to accept. But they have they get a problem. They've got to put the premiums up, and then we're all part of that outcome to try and either replace that cover if that's even possible, or try and adjust what you've already got to make it affordable into the future for yourselves.
What would you say, Simone, with regards to the whole affordability question? What would your comments be?
Oh, look, I think that affordability has been something that people have used their superannuation a little bit for, to be able to sort of pay some of those premiums out of superannuation, either partially or fully. And I think that comes, like, each situation is different. So sometimes when you just can't afford the cover personally, it might be a good option to be able to do that. The other side of that is eroding your superannuation. If you're paying all of the premiums out of that superannuation, you're sort of pushing a bit of a problem down the road a little bit too. So, I mean, we've seen lots of different types of ways to fund insurance through superannuation, particularly over the last sort of 10 years, where there's different linked policies that you can partially pay, premiums outside and premiums inside. But, there are a few things to consider in addition to just affordability that we don't often, maybe it's not, I don't know, these nuances and these really sort of these terms in the different laws that govern superannuation and tax. There's a couple of crossover points that might trip you up at a claim, and one of those is that there are some differences in the Tax Act versus the Superannuation Industry Supervision Act, which we call the SIS Act, and it's about dependents, and if you're having if you've got a superannuation policy that's inside, an insurance policy that's inside superannuation and it's paid to a dependent, but they're not a dependent for tax purposes, and that person might have some tax to pay. So it's really sort of using superannuation. It's not just okay, this is helping us for affordability. It's consider all of the aspects of it. Consider consider at claim time if you're going to have extra tax to pay. Consider eroding your superannuation. Yes, it might help you with some of the cash flow in the meantime, but it's very there's more than just that affordability point.
It sounds like it's not a one size fits all as to where your policies should be held.
That's right.
Not only is there the tax, there's the super. So you need all your advisors sort of working together, don't you, to make sure that they understand what's going on in your situation. You want to add something to that, Mitch?
I was going to say it's a constant conversation of trade-offs. If this does that, this is the outcome. And so people being informed and making their own choices is fine, but ultimately the law is the law. The PDS, the product disclosure statement, has written in there how they're going to react if something happens. And so it's just about people understanding their own trade-offs.
Yeah, I think it's a good way to put it, isn't it? Yeah, when you're in your 20s and you're not necessarily thinking so much about longer term and risk and so forth, it might be hard to commit to an insurance policy that might actually save you money over a long period of time. When we haven't even got into things like leveled premiums and stepped premiums and agreed values and all those types of things. But obviously you need to look at that with your own specific circumstances.
Yeah.
Simone, you've already covered off on some of the superannuation sort of considerations for us, which is really part of the question as to who should own the policy. But there's a whole range of things to think about there from a business perspective as well. If you've got a buy-sell agreement in place, does the business own the policy or does the individual own the policy to guarantee payouts? My big comment there would be just make sure you get expert advice from someone who knows your full situation, personal and business, of all the parties involved, because it can really get messed up if it's not done right. Guys, I'm gonna probably wrap it up there, but I want to ask you guys to share with us, I suppose, a final tip, final takeaway, or some parting comments for our audience today.
I would say, number one, in should ever the case come that you want to reduce or get rid of one's cover and not afford the premium anymore, which of course is your own election to do that if that's the case, before you go and do that, go and see your GP, check out your own stats. Know you haven't got high blood pressure, you're walking playing with a heart attack or stroke. Make some informed choice about your health before you go and change your own cover. And that leads to another very brief comment to say, it's often the case that loadings or exclusions can be put onto insurances when they're applied for. That could be some years down the track before they might be eligible to be removed again. The insurance company doesn't proactively come to you asking to remove those. You need to proactively go back to them. And depending on the situation as to why they're put on, they may be able to be removed, reduced, or so you can save money and have a better contract just by reviewing what you're doing in some occasions.
So I'm hearing there, be proactive, not only about what you're covered for, but be proactive through the claims process as well. When the process of getting that doctor's letter to go to the insurance company is not a fun process, but obviously anything you can do to prevent that exclusion and that loading is going to be a good thing for you. What about you, Simone? Parting comments?
Yeah, look, with insurance, I think that until you've really started the process, you don't necessarily understand what your risks are. So my key takeaway would be to start by understanding what your risks are. If you couldn't work for an extended period of time or an unforeseen event happen, what's it going to do to your financial situation? What's it going to do to your family? Sit down and think about it, because before you start, it's often something that we might not have thought about in a lot of detail, but when you see the numbers on the page and you understand your financial situation, you really want to make sure that these events are not impacting your future goals. So it's really important to understand what your risks are.
Yeah, and I think my tip would probably come from probably a bit of a business perspective. Just make sure you got all your advisors talking together, because you need that lawyer to document the buy-sell agreements. Make sure it lines up with your shareholders agreement. Make sure you've got your accountant and your insurance and you know the debt situations and everything, so that it's all coming together, so that we can minimize some of this risk within your lives, really. Even though it's business related as well, it's about the people behind the business more than anything else. So make sure you get them all working together. Guys, thank you so much for your discussion and your insights today, specifically around the insurance. I think we could dive into some of those topics a bit deeper as an individual topic sort of down the track, but that was a great sort of cover of the overarching sort of personal insurances. Of course, a copy of this recording will be on our website either later today or tomorrow. We'll send out the attendees or the registrants with a link to that webinar, but of course it'll be on our website forever and a day. So if you ever want to revisit this, don't hesitate to go to businessdepot.com.au. Of course, if you love it, if you think you're getting value out of these webinars, please send them on to your friends. We'd love to get some more people coming on board, because we just want to help more people get their affairs in order. Our next What They Didn't Teach You at School webinar with the financial planning sort of focus is going to be on the 15th of July. And that one is going to be about investments. So we're going to have a discussion about broad investment types. I think I've heard a whisper that they're going to turn the table and they're going to ask me a few questions in that one from a property investment perspective. And of course, also at Business Depot, we have our calm tax combos. Now we're coming up to tax time. So on the 15th of June, I'll be joined by Jackie Reeves, our head of tax, and we're going to be talking about tax planning tips for 2021 financial year. Anyway, I hope you've enjoyed that. And of course, if you do have any questions after the end, please don't hesitate to reach out to either myself, Mitch, or Simone. We'd be more than happy to guide you in the right direction. Thank you very much, everyone.
Thank you. Bye.